Hi guys, welcome back to TipRanks. My name is Annika, and here at TipRanks, we love to hear what different stocks you're looking at and your opinions on the market sentiment. Well, in this video, we're going to look at two stocks that are trading at discounted prices and Oppenheimer analysts deem a buy. They have over 70% upside potential. And before we jump into this video, don't forget to hit that like button and the subscribe button and that bell notification so that you get informed on when the TipRanks channel releases a video. Chief Investment Strategist from Oppenheimer, John Stoltzfus, says that investors should not become pessimistic just yet with what's been happening. Stoltzfus believes that the upcoming months will give us relief from the pandemic and supply chain crisis. In fact, he encourages investors to write lists of sound stocks, thematic investments, ideas, sectors that could have gotten away from us from last year's market upswings. So it seems like he's very bullish for 2022 despite what's been happening in the market. With the fact that the Nasdaq has been down almost 13% at the start of 2022, this was a loss that essentially erased a 12-month gain. The first stock that Oppenheimer analysts deem a buy is Hertz Global, and its ticker is HTZ. This is the car rental giant that operates the Hertz Dollar and Thrifty rental companies. They have a worldwide reach with over 10,000 locations in over 145 countries in over 6 continents. They have a worldwide reach in more than 10,000 locations in 145 countries in 6 continents. The current price for HTZ stock is $19.75. The analyst rating consensus is a moderate buy based on 6 ratings, which say 2 are a hold and 4 are a buy. The analyst price target is $30, which is a whopping 51.82% upside. Hertz did, however, have a weakness. During the pandemic, it was quite exposed. Hertz usually depends on a customer base that's in transit, and obviously the pandemic shut down travel, and it sort of slammed the company, and it drastically reduced the value of its chief asset, which is its extensive car fleet. Furthermore, it wasn't great because Hertz creditors called in their loans, which had been secured by those very car fleets. This combination wasn't great, and Hertz entered a bankruptcy proceedings in May. But after more than a year of litigation and restructuring, the company emerged in July 2021 in a strong position, having discharged $5 billion in debt and secured a $5.9 billion in new capital. So the current market cap for Hertz is $9.1 billion. And they reported a strong Q3 2021 quarterly report. In fact, it shows the extent of the company's turned fortunes. The top line revenue was $2.2 billion, and this was up 19% from the second quarter of 2021. The adjusted diluted EPS was $1.20, and this was enormously improved from the Q3 2020 EPS loss of 44 cents. The company had around $2.7 billion in unrestricted cash as of September 30th, 2021, and the company will report its Q4 results towards the end of February. Now, in addition to these fantastic financials, Hertz has been moving to align its business with modern trends, and this includes the company partnering with the used vehicle e-commerce company Carvana to streamline its used car disposition channels. Basically, this partnership will see Hertz sell used fleet vehicles through Carvana to benefit both companies. Also, Hertz is working with Uber and Tesla on a project to electrify its rental fleet, and it will be making up to 50,000 Tesla vehicles available to customers who rent through Uber's network. In short, clearly Hertz has emerged from bankruptcy with a solid plan to move forward, and it has an ability to execute on it. Nevertheless, the stock is down 48% from its peak that it reached in November of last year. But taking a look at analyst forecast Ian Zaffino from Oppenheimer, he gives it a price target of $31 with a buy rating, and this price target is a 60.46% upside. He says that with a meaningfully improved cost structure, an under-leveraged balance sheet, and a newfound competitive discipline, we believe Hertz is an interesting post-bankruptcy equity. The company has the potential to roughly double its pre-COVID EBITDA margins, even as auto production and the operating environment normalize. And on top of that, he says that Hertz has been highly forward-looking as it positions itself for the future of the rental industry. It recently announced agreements with Tesla, Carvana, and Uber, and the Tesla deal has the potential to be margin accretive, especially if EVs prove to have better economics. Further, the Carvana partnership expands Hertz's disposition channel and could add more than $50 million to EBITDA. The second stock is Vacasa, and its ticker is VCSA. Vacasa is a vacation management company. They connect vacationers with places to stay. They've also benefited greatly from the reopening of the economy and, of course, the gradual scaling back of the lockdown restrictions. Vacasa is based in Portland, Oregon. The company operates in 34 US states, plus countries of Canada, Mexico, Belize, and Costa Rica. Its homes, totaling more than 35,000, have picked up nearly 300,000 five-star reviews. And Vacasa boasts that it facilitates vacation stays for more than 3 million guests annually. Vacasa went public just this past December through a SPAC transaction with TPG Pace Solutions Corporation. The deal saw the VCSA ticker start trading on December 7th, and it brought the company over $340 million in new capital. So from one perspective, the company went public just at the right time. Customer behavior trends were changing in favorable manners in the recent months, as many people were finding that they can actually travel and have the funds to do so. The company released its Q3 2021 result a few weeks before completing the SPAC transaction, and it showed a record revenue of $330 million. This was a 77% gain year over year, and it beat the company's quarterly revenue target by 28%. The company sold over 1.8 vacation nights in Q3, well above the 1.1 million sold in the year-ago quarter. Well, looking forward, Vacasa raised its full year 2021 revenue guidance by more than $100 million to the range of $872 million to $877 million. Now, the current Vacasa stock price is $6.15. The analyst rating consensus is a moderate buy, but the analyst price target is $12.40, which is a whopping 101.63% upside based on 7 Wall Street analysts offering 12-month price targets. Now, looking at the company's stock price, it might seem a little bit concerning at first glance since the stock is down 40% since going public. But Oppenheimer analyst Jed Kelly is bullish, and he deems it to be a buy with a $12 price target, which is a 99.34% upside. He said that Vacasa is leveraging its position as the largest vacation rental management platform in the US to increase its scale advantages and acquire outsized inventory share as consumer preference for the segment grows. We see this dynamic facilitating Vacasa's evolution into a national hospitality brand and generating upward revisions to long-term estimates. Additionally, we expect a robust demand environment continuing into 2022. So guys, what do you think of those two stocks that Oppenheimer analysts deem a buy, with around an average between the two of a 70% upside potential? And also, if you guys made it this far, don't forget to hit that like button and the subscribe button and that bell notification so that you get informed on when the TipRanks channel releases a video. Remember, this is not financial advice. Make sure you do your own research before you invest in anything. Thank you guys for watching. I'll see you in the next video. Bye!